Okay, so I've heard a lot that your interest rate might be high, but your rent is 100%. While you can consider rent 100% interest because technically it doesn't go towards ownership, now you have to factor in what a mortgage actually entails. So let's talk about the first year of a mortgage. Now we're offsetting the fact that you're paying rent instead of paying a mortgage. We want to consider your cheapest rent payment and your cheapest mortgage payment. So when you make a minimum payment on your mortgage for the first year at 7%, if it's a $3,000 mortgage payment including taxes, we're looking at something like $1,000 goes to taxes, 18 or 1700 goes to interest, and 200 or 300 goes towards principal. So the first thing that we always want to do is consider a mortgage as a minimum payment and not a payment due, right? We want to pay additional principal so that we can actually build equity in a home. Things come along with a mortgage that don't necessarily come along with a rental payment, like fixing the home, paying for certain utilities that might be all included in a rent payment, saving and budgeting for things that could possibly go wrong, and factoring in whether or not the interest rates are going to go back up or down, how soon it's going to happen, and whether or not the purchase price of the home is going to sustain if the market takes a hit and values go down. Minimum down payment into a home with an FHA loan on a mortgage payment that is possibly more expensive than it would be for renting could potentially not be the smartest move for anybody. So where do we have to focus to make sure that buying a home is actually a smart move? Because it is.